Hello, I'm Adrian Finnegan, and this is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, from coffee shipments to oil tankers, attacks by Houthi forces in the Red Sea are disrupting global trade. Could that push up prices and fuel inflation? Also this week, Africa's debt is crippling the continent's development. Its leaders demanded reform of the global financial system at the G77 Summit. Plus, selling sleep. Companies are increasingly investing in the quest for rest. We look at how bedtime has become a multi-billion-dollar business. Now, inflation was expected to ease in 2024 after more than 18 months of interest rate hikes by central banks, the most aggressive monetary tightening in decades. But attacks by Houthi rebels in the Red Sea are threatening to push up the cost of living again. The geopolitical tensions have disrupted global trade, sending shipping and insurance costs soaring. A widening war in the oil-producing region could further worsen people's finances. But why is the route so important? Well, the Suez Canal is the quickest sea route between Asia and Europe, but any ship passing through, either to or from the Indian Ocean, has to come through the Strait of Bab al-Mandab in the Red Sea. And the Houthi rebels there have attacked vessels transporting goods through that strait that they say are linked to Israel. Many of the world's largest shipping firms are now taking a longer journey around Africa's Cape of Good Hope. That adds at least 10 days to shipping times and costs companies millions of dollars. Well, those additional costs could be passed on by businesses to customers. More than 12% of annual global trade passes through the Red Sea. That's $1 trillion worth of goods every year, including oil, coffee, fruits and electronics. Food and grocery costs could go up if shipping disruption worsens, but it's energy prices that worry governments the most because they are the biggest risk to inflation. The international benchmark, Brent crude, rose briefly to $80 a barrel after the US and UK took military action against the Houthis in Yemen. Joining us from Brussels, Frederick Eriksson, who is the director of the European Centre for International Political Economy. Good to have you with us, Frederick. Now, 2024, as we said, was meant to be the year that inflation began to dissipate, but with rising tension in the Middle East and those attacks in the Red Sea, is that still going to be the case?
Well, let's hope. I think that's perhaps the most prudent thing to do. I mean, as you said, we are right now in a situation where we have a couple of developments that are pushing up freight costs and a few other costs, which of course are making life much more difficult for the central banks that had planned, probably, I mean, as far as we know, to start cutting the interest rates during 2024 and in that way try to help economies to recover again from the economic downturns that we have seen since they started monetary tightening. And that may now be delayed.
So are interest rates going to remain more or less where they are now, or do you foresee another spike like the ones we had following the COVID pandemic and at the beginning of the Ukraine war?
If you look at the stuff that you buy in a retail store that were imported and had been transported through the Suez Canal, it's a very, very marginal part of that cost that is actually about freight costs. However, as that cost is going up, as we see a few other developments, as you mentioned, oil prices has begun to move a bit. And of course that we have a few other problems, for instance, that the winter has proven to be a bit cold. And we have more energy demand right now, which is helping to push up energy costs a bit, at least in the European part of the world. That in itself presents a situation where I don't think central banks feel confident that they have control over inflation and that they now can start to be confident about that they can reduce policy rates, and they try to sort of be sure that before they're now going to start to cut interest rates and in that way help the economy to revive, they need to have inflation down to levels where they are stable and secure at these low elevated levels.
But if the war widens, God forbid, to the wider Middle East region, I mean, that's not going to do anything to help inflation, is it? I mean, how bad could things get for the likes of you, me, and anyone watching?
Well, I mean, there are, of course, scenarios that we can talk about and entertain, which is going to have a significant impact on the world economy at large, not just on freight costs and on transport costs more generally, but a larger regional war in the Middle East, other type of conflicts, of course, that's going to have a very, very huge impact and basically knock central banks off the course they've been on for a couple of months now, which has been pointing in the direction of cutting interest rates. If that happens, I mean, then we are most likely going to see central banks starting to fueling the economy with more liquidity again. So we are in an inflationary cycle in more ways than just that oil prices or other costs are going to go up.
Frederick, I'll be back with you in just a moment, but first I want to talk about perhaps what could be described as the opposite of inflation. Mouthwash, tea bags, sausages, to name but a few. Pack sizes are becoming smaller, but the price hasn't reduced. The practice is known as shrinkflation. Manufacturers say that it helped make products more affordable for consumers as the rising cost of living begins to bite. But a new study by Ipsos research company has found that almost half of consumers surveyed find shrinkflation unacceptable, with the French most upset, while North America and Europe has the highest rate of dissatisfaction with the practice. Consumers in Asia, Pacific and Latin America have shown less discontent for the moment. The two regions, though, have a much smaller proportion of consumers than Europe, who said that they'd noticed shrinkflation. Frederick, what do you make of shrinkflation? Is it here to stay? I mean, how much smaller can products get?
Yes, indeed. Well, we're going to find out, won't we? Look, what I think we're talking about, I mean, there are a few differences across the world here, and these differences in terms of how producers have perhaps reduced the size of the products or done other ways in order to find a strategy to balance costs and avoiding to push over a lot of cost on the consumer. In countries and in regions where inflation has been very, very high, I think a lot of producers have been confronted with realities that if they pass on all the increasing costs they have to the consumer, consumers won't buy the products. So they've started to play with other strategies, like, for instance, reducing the size of the content of the product. For instance, if you talk about food, I think that's been the most obvious ones. There's been a few other sort of strategies as well, but I think it's been very, very strongly linked to the rise in inflation and the problems connected with finding a way to sort of avoid that consumers are going to bear all the cost, because if that's the case, there's going to be just a very, very sharp drop in consumer demand and in consumer purchases of these particular products. So I think that's predominantly what we've been talking about here. Then, of course, you have the more generic development, which we have seen over a long period of time, which, of course, is that producers of electronics or food or other type of expendables are over time trying to size their products in a way that fits with everything from greener ambitions, avoidance of food waste, and I don't think that's going to be changed in any time soon. But the more sort of shrinkflation part, I think that's a phenomenon which has been intimately linked to high inflation rates. And if inflation rates come down, then of course we're probably not going to see companies playing around with that so much anymore.
Frederick, it's been really good to talk to you on Counting the Cost. Many thanks indeed for being with us. Now, the UN says that Africa's public debt stood at $1.8 trillion in 2022. That's an increase of 183% since 2010. African nations now spend more money on servicing interest on their debt than health or education, and many of them are unable to invest in sustainable development. Yet the share of official development assistance going to Africa is at its lowest level in more than 2 decades. To address the needs of the developing world, the UN and African leaders demanded reform of the global financial system at the G77 Summit. Kulsum Sharif reports.
Africa's Debt Summit cast a shadow over the third South Summit in Uganda's capital, Kampala. The Group of 77, or G77, represents the world's largest intercontinental organization of developing countries in the UN. The bloc, representing 80% of world population, is burdened by growing financial liabilities. Several economies are considered at risk of debt distress by international institutions. UN Secretary-General Antonio Guterres addressed the inaugural session. He criticized outdated financial agencies, saying they fail to provide a safety net for developing countries in distress.
Financial institutions and frameworks created after the Second World War still largely correspond to the power relations and the global economy of that time. They must be reformed so that they are truly universal, reflect with justice the realities of today, and are much more responsive to the needs of developing countries.
The theme of the summit was to help reduce the widening gap between rich and poor nations. A UN agency says African debt has been rising at a rate that's constraining its growth. The World Bank has sounded an alarm over the continent's prospects. G77 leaders accuse global institutions of little help and favouring rich northern countries. Ugandan President Yoweri Museveni, the current chair, rallied member states for unity to increase economic cooperation.
I will push those 3 points: production of goods and services, how to encourage that interlinkage, dealing with the issue of markets, and then the issue of the infrastructure. But this assumes that we have peace among ourselves, which is another issue. Because if we don't have peace, then we shall not achieve this.
But analysts say despite the challenges developing countries face, the global south, that includes some 130 countries, are on the rise. 77 developing countries formed the bloc in 1964 to promote economic interests. It now includes 130 nations with backing from China. This year, the bloc is demanding a fair treatment in the global financial system. Kulsum Sharif, Al Jazeera, for Counting the Cost.
Well, to unpack all of that, we're joined from Dakar, Senegal, by Duda Benner, who is the CEO of the Global Development Advisory AfriCatalyst. Good to have you with us, Duda. What do you make then of the G77 summit? Did it really address the concerns of the developing world, particularly your part of the world?
Well, thank you very much for having me. I think the G77 summit was certainly very much welcome in Africa in many ways, because as you know, that's an intergovernmental organization that aims to promote collective economic interests of its members. It also aims to sort of strengthen cooperation between the global South countries, and at the same time also help strengthen their negotiating capacity. So, of course, when they talk about these issues like the reform of the global financial architecture, debt, or climate finance, those are issues that are at the heart of the African agenda. So, yes, I think this summit was very much welcome, and the fact that now an African country, Uganda, is now chairing the G77 is certainly going to be very much helping the group in better targeting its support for Africa, for its African members and other developing countries that are members of the group.
We heard a little bit about it in the report, but how did African nations find themselves trapped in this vicious cycle of debt?
Yes, so I think maybe before responding, just qualifying here, because I think it's not African countries that are in debt, but many African countries, of course, are currently facing increasing sort of debt burden. And the reason is actually quite multifold. First of all, this started before the pandemic. So I think many African countries felt legitimately the needs to respond to development demands and the needs for infrastructure, the needs to respond also to climate climate shocks. As you know, Africa is also very prone to having natural disasters. So all of those needs actually led the governments to borrow more to respond to those needs, particularly with regard to infrastructure. And that was before the pandemic. And when the pandemic arrived, what happened, of course, was there was a legitimate need to respond to the pandemic. And I think that was also something that pushed the governments to borrow more to be able to sort of relieve their population from the shock of from the impact of the pandemic, and certainly that had a bearing on their burden, on their debt level. And I think also what happened after the pandemic was, of course, the war in Ukraine, that also sort of boost and sort of cause some higher energy and food prices that also contributed to higher cost of living. And of course, there also many countries in Africa felt the need to sort of subsidize a little bit, key energy and food products. And of course, that also require borrowing from domestic markets, from international markets, and also from bilateral creditors. All of that actually contributed to the current situation that we see, with debt being quite a big sort of issue and a big challenge in many African countries.
You talk about the high cost of living. To what extent is this cycle of debt and the servicing of the debt holding the people of the continent back?
Well, I think the high level of debt has very damaging consequences in many ways. First of all, it has some sort of very damaging macroeconomic impact, in the sense that it's actually may lead to some, fiscal policy challenges. It may also create some financial stability risk. And I think this is something that unfortunately many indebted countries or countries that are in the distress are facing. But it can also have some external impact, in the sense that it can also cause some external stability sort of issues, in the sense that the countries that are very much servicing high debt actually may also face some exchange rate pressure. They also may face some ability to maintain their reserve, the international reserve, at an adequate level. All of that is unfortunately having some very much real human impact, in the sense that the population is bearing the cost of all of those challenges that I talked about.
Among Africa's demands is reform of the global financial system and Bretton Woods institutions. Is that a far-fetched notion? I mean, how realistic a prospect is that?
I'm not so sure it is far-fetched, because if you look at it, this is a demand that has been made by Africa and many other developing countries from the G77 and others for a long time. And the good thing is that reform is already underway. The problem is, unfortunately, the speed and the ambition is not really there. And I think that's where many African countries are very much disappointed with what is going on. You take it, for instance, I think the reform of the Multilateral Development Bank, which is part of the reform of the global financial architecture, has received some momentum recently. I think we have seen institutions like the World Bank announcing very sort of ambitious reform agenda. Of course, they need to deliver for Africa to be very much in tune, and that's not necessarily yet the case given the slowness of the reform process that I talked about. But this is something that also is something that we see in the debt issue. I think in debt also, the reforms there are very much slow, and this is also something that is really of concern for many developing countries, not just in Africa, but many other around the world that are facing debt issues. So yes, I think the call that was made for at the G77 Summit for a faster reform of the global financial architecture is very much legitimate, and we are hoping that other bodies, not just the G77, but also the G20, the G7, and the BRICS also would be very much pushing, which they have been doing, but I hope that would translate into concrete progress.
Duda, really good to talk to you on Counting the Cost. Many thanks indeed for being with us.
Thank you.
Now, a good night's sleep is everyone's dream. Many brands have woken up to the business potential of that. They're selling products, services, and applications meant to provide better Z time. The so-called sleep economy is expected to be worth $585 billion this year. And it's not only big companies that are raking in profit. Imagine being able to make money while you sleep. Well, social media influencer Alex Shannon says he's done just that, earning more than $50,000 in 18 months by sleeping at luxury hotels. Known for his account @FollowTheNap on Instagram, Alex is among a growing number of so-called sleepfluencers streaming live footage of themselves under the covers. And it's not just content producers that are cashing in on bedtime. A host of brands are trying to profit from people's dreams. Products such as high-tech pajamas, robots, and hug blankets, yes, you heard that right, are now flooding the market. All of them intended to help you doze off, and some of those items can cost a fortune.
What do you do for a living?
Me? I sell luxury beds, handcrafted in Sweden.
Oh, beds?
Yes, indeed.
Oh, what's the most expensive bed that you sell?
Well, we top out at $689,000.
Oh my God.
$689,000 for a king size. Some of those beds are entirely handmade, and it takes master craftsmen at least 600 hours to make them. Others are made of horsehair. Exploding Topics reported that the global mattress market is worth more than $50 billion right now, but is estimated to surpass $75 billion by 2030. But should people even be paying that much to buy their bed of roses? Well, the impact of expensive mattresses on a good night's sleep is disputed by science. One of the reasons why people buy into the business is an exploding appetite for extravagance. But studies have found that a good nap boosts productivity and could save economies billions of dollars. So there is indeed money to be made between the sheets. Sweet dreams. Joining us from Lucerne in Switzerland is Elmar Vanderhelm. She's an international sleep expert, an adjunct professor at IE Business School and lecturer at IMD Business School. Good to have you with us. So what's behind the booming business of sleep?
A couple of really big trends. First of all, unfortunately, a lot of us are not getting enough sleep. We see, for instance, that about 35% of the population says that they're sleeping less than 7 hours, even though 7 to 9 is recommended. But apart from that, we also see a general increased interest in our own health and our well-being. Unfortunately, we also just see that people suffer more from stress and, kind of unhealthy lifestyle factors. If you just look at the percentage of people who work shifts, it's about 17%. And we know that that really messes up your biological clock and hence your sleep and your health. So I think there's a lot to fix when it comes to people's sleep. And with that, we, of course, see this big trend of advances in technology that make it finally much more affordable for people to track and monitor their own sleep.
Not everyone, of course, can afford to buy themselves an expensive mattress. Are the companies that produce those turning sleep into a luxury?
Well, I think one definitely very concerning aspect of this conversation around sleep is the message that sleep is a luxury. We really need to remove that notion that sleep is a luxury and replace it with the truth, which is sleep is something we all need, we all deserve, and something that unifies us. So we definitely, of course, see some players kind of aiming for that high end of the market. And we, for instance, also see that those with a higher income are more likely to have a sleep tracker. But that said, you definitely don't need to buy a very expensive mattress to have good sleep. I actually think that a lot of this, sleep is a luxury comes more from the inequity that we see. We just see that when people have concerns about their finances, they are less likely to get good sleep. On average, they sleep 10 minutes less a night. So there's a lot of factors that contribute to those who work shifts, those with a lower income, or those in developing countries to have worse sleep. And that's something that I think we should all worry about.
Is it all in the end just good marketing, or is there some solid science behind all of this?
That's a good question. There's definitely increasingly more science behind it. So that's good. You see more and more of these startups and also bigger name companies reaching out to sleep experts to collaborate with them, really running studies to see whether their products are in fact, improving sleep. But that said, I would say that's maybe 20% of the total market. And yes, a lot of it is marketing. And I think we should all keep in mind that a lot of us can improve our own sleep simply by behavior change. But in my experience, people tend to just prefer to buy a simple product as opposed to putting in the hard work.
Els, it's been really good to talk to you on Counting the Cost. Many thanks indeed for being with us.
You're welcome, Adrian.
And that's our show for this week. If you'd like to comment on anything that you've seen, you can get in touch with us. I'm at @afinnegan on X. Try to remember to use the hashtag AJCTC when you do, or you could drop us a line. Countingthecost@aljazeera.net is our email address. As always, there's plenty more for you online at aljazeera.com/CTC. That takes you straight to our page, and there you'll find individual reports, links, and entire episodes for you to catch up on. But that is it for this edition of Counting the Cost. I'm Adrian Finnegan from the whole team here in Doha. Thanks for being with us. The news on Al Jazeera is next.